Hey everyone, Eric Dutram here with the latest edition of the Dutram Report, the podcast on ETFs and more. Today we're taking a look at the FANG stocks and what is going on in the world of technology and new media these days. To take us through this market, we have Scott Fries, the CIO of Sabretooth Advisors. His company has launched a FANG-focused fund, and he lets us know why this group is special and what investors can expect from the tech world in the months to come too. But if you have any questions or comments, make sure to send them in to podcast@zacks.com. Don't forget to find the Dutram Report on iTunes and give us a review there as well. But stay tuned for my chat with Scott right after this. Okay, Scott, thanks for joining us today. So you're here to discuss the new tech and media world. And I first want to start off by discussing the FANG group of companies. And this has obviously been in the news a lot lately. It's Facebook, Amazon, Netflix, and Google. Now, why do you think the FANG stocks have captivated investors' interest as of late?
Well, I think it's just a follow-through on what you've seen for the last 3 or 4 years. These are the most innovative companies that are out there, not just in terms of revenue growth and earnings growth, but also as far as product lines, the way that they're changing the way that we live our lives, order products, watch TV, self-driving cars, things that 20 years ago you wouldn't really think was possible. You had Amazon was an online bookstore, and now it's basically infiltrated every part of somebody's life to some degree or another, whether it be through Whole Foods, whether it's your shopping from like Costco, BJ's type shopping orders, Amazon Prime, where you're getting your one-day deliveries, there are Amazon TV shows. They've really pretty much run the whole gauntlet of soup to nuts on everything that consumers will do, and it only looks like they're going to keep on getting bigger and going into more and more product lines. So that's an easy one for why people are talking about the company and interested in the company. Facebook has, I think, over 1 billion users now, not even including Instagram, where they're going generational. So you have all the people that are my age in their mid-40s that are on Facebook, and then you have our children who only use Instagram. And then I'm sure the next great product that comes up for the next generation, they'll end up buying that at some point in time and be able to put a tentacle out to social media through all those avenues. Netflix, the big cord cutter, and that's been on everybody's mind for the last year and a half or so. And then they have their programming, all of the even the Disney movies up until recently that you would get from Netflix, and it's just that one service as opposed to sending away for DVDs and having them mailed to you. So it's something that, these 4 companies have really been into every facet of a consumer's life in one way or another for the last few years, and they just seem to be growing and growing and growing and getting into more and more aspects of that life. But I would like to point out that Netflix specifically, out of those 4 names, probably has the lowest barriers to entry as far as competitors coming into the business, and you've seen that with the Disney news a couple weeks ago. So as far as some people are concerned, myself included, the N in FANG is Nvidia as opposed to Netflix.
Okay, well, why do you think Nvidia should be replacing them?
Not just because it's been the hottest stock in the market, but if you look at where Nvidia has been and what they're doing, it's gone from being a chip maker and a video game company that works with different computer systems and video game systems and high-end video game systems to where now they're the self-driving car manufacturer. Since Mobileye was taken over by Intel, Nvidia is the one that's out there putting their chips into the next generation of technology, the next generation of AI. So we feel that Nvidia going forward would be the N in the FANG names as opposed to Netflix, which, they had a great earnings period, and there's nothing to say they're not going to continue to grow. But they do seem to have a little rockier road ahead of them than the other ones, whereas Nvidia looks like it's still on that explosive growth plane.
Sure. So would you say, to you at least, the FANG is more about spreading across a number of markets and seeing strong growth? Is that how, they get lumped together, at least in your mind?
Yeah, and the term that I like to use is disruptive innovators. So the FANG companies in essence, are more than just Facebook, Amazon, Netflix, or Nvidia, and Google. It's a concept. It's disruptive innovators that are changing the way that we live and changing the ways that we invest as far as what the expectations are from an investor standpoint on growth, revenue growth, earnings growth, and product pipelines.
I also wanted to ask you about Alibaba. A lot of people move them into this sort of a newest FANG member, make it FAANG. How did they join the club, and do you agree with that assessment that they're sort of on the cusp of being one of these new hot stocks?
I absolutely have them in there as FAANG. Some people have it as Apple. I have it as Alibaba. When we started to put our ETF together, the marketing materials were actually FAANG with Alibaba in there as the second A. It's Amazon in Asia. And they created their own holiday, Singles Day, just to sell product, just like Amazon has Amazon Day. And year over year, the concerns have always been, well, it's a Chinese company, the government can clamp down on them, how are they going to be able to do X, Y, and Z? And year after year, they've proven that not only can they sway everybody's opinion and be successful, but they continue to grow and to innovate and come out with new ideas where they really are Amazon, just on the Far East as opposed to the Western world.
Gotcha. Yeah, and I think that Singles Day, they end up having more sales than the Prime Day back here in the U.S., if I'm not mistaken, right?
Yeah, and every year when you say, wow, that was amazing, there's no way that they can have the same exponential growth next year, they come out the next year and they exponentially top the previous year's numbers. It's crazy.
And, I wanted to talk about what we've been seeing the last couple of weeks or maybe a month in this space. There's definitely been some rocky trading in a couple of the names. Now, some people out there say it's a bubble, but what do you say to those people out there who are worried about the recent trend in this corner of the market?
Well, I wouldn't necessarily say it's a trend as much as perhaps basing or a healthy sell-off. For as many people that say, wow, this is a really overvalued marketplace, these stocks are too expensive, they've topped out, you have the same number of people on the other side saying, yes, they're expensive, but the fact that they are expensive on a per-share basis does not necessarily mean that they are overvalued. So Amazon, for August, Amazon's down 4.2%, Facebook was down 1%, Google was down 1%, Netflix was down 7%. Some of that is also earnings related and some of the geopolitical goings on this past month. Some of it's just profit taking. But if you looked at these quote unquote expensive stocks and think what would happen if these guys split? If Amazon or Google came out with a 5-for-1 or a 10-for-1 split and was a $100 company, even though investors know or should know that doesn't change the value or the market cap of the company, it would be viewed as, hey, this is a great place to get in. People just, I think, get worried because, hey, this is a $1,000 stock. You can't trade a $1,000 stock. It's too expensive. It has to come down at some point in time. And that's really narrow and short-sighted thinking. If the earnings stream is there, if the company is strong, and if revenues are growing quarter after quarter, year after year, then you would expect the stock price to continue to grow year after year, quarter after quarter. Now, at some point in time, historically speaking, it will come to an end. If this was the turn of the 20th century, the FANG names would be railroad stocks. In the 20s, it was the radio stocks. Even if it was the 90s, to something that everybody can remember, this ETF would be made up of, or this sector would be made up of, AOL, Sun Microsystems, iOmega, GeoCities, those kinds of companies that Netscape that nobody would want to own now. And they had a fantastic run for a bunch of years, but times changed, technology changed, and they either didn't evolve with it or new competitors came out with better products. So FANG is more of an idea of this disruptive innovation, not necessarily the bleeding edge of technology, but the leading edge of technology, where it's something that's light years ahead of its competitors. And if they continue to grow and become more and more viable and come out with new products and not just sit still and be complacent, then they'll last longer. But at some point in time, technology will change again. There will be new innovators that will take the place of the current FANG names, but they're still going to have the same underlying characteristics of the current day FANG names.
Yeah, and this is probably a good time to mention the new tech and media ETF that you guys have. The symbol is FNG. Now, this is an active fund, and I'm guessing part of that active approach is based on this idea that you're talking about, that FANG is really more of a concept than 4 or 5 companies. Is that fair to say?
Absolutely. Yeah, if it was just 5 companies, you would have a very small, concentrated, non-diversified product that at some point in time, if you think of the like the holders ETFs that were popular 10, 15 years ago, where it was a set number of companies, and this is what it is, and it never changes. They were very popular for a point in time when those companies were popular, or in the case of the oil holders, when oil was $100 a barrel. Things change. Nothing stays static throughout time. So now those are not popular products. Nobody really trades them or is interested in them like they used to be because they didn't have the capability to evolve. So when we were looking at the FNG ETF and did we want to set up an index and make it a passive index-based ETF, what would we put in there? And the concern was we know that over time, what is a disruptive innovator, what is a market leader, what is the high-growth stocks in the marketplace, they're going to change. So if we have an active strategy, we're doing the work for the investor. We can go in, and this has already happened in the first 2 months with the FNG ETF. You have companies that qualify as disruptive innovators. They're doing everything right. They're growing. They're innovating. They're coming out with new products. At some point in time, you reach maturity, and then it's do you evolve or do you just become, say, value, as if it was going from a growth to a value company.
Maybe you could argue that's happened with a giant company like Apple, per se, that was viewed as a growth name by many, but now, pretty high dividend, and I think a lot of people view it as almost a value stock these days.
Yeah. Some people look at it as a bond. I think the big turning point for Apple and the one that will determine the future is going to be the 8 launch. I don't think I've seen this much excitement and expectations for any of their products for maybe 4 product cycles. So it'll be very interesting to see what happens with Apple. I mean, they're up, I think, like 8% for the month. They've absolutely exploded after earnings, and with the forward guidance that came out, and everybody looking forward to the 8. If that's a bad launch, or if anything happens, guidance changes, consumers don't like it, you could obviously see that pull back significantly and just become a value stock somebody gets for a dividend play. Political factors such as repatriating cash, that could have something to do with part of the gain if people expect that something will be done to cut a deal that way as well. But there's a lot of names that you have to ask that question over time of, is this still a growth stock?
Sure, and you know what? Maybe let's talk about some of the other companies in the fund that might be surprising to some investors out there. There's about 2 dozen in FNG right now. You got your big name players, but what are some smaller ones that might be a little more unknown, if you will, to investors out there?
Sure. I mean, 2 that come to mind that I actually really like are Shopify and Square, where you're looking at basically payment devices. In the case of Square, there's some technology within their readers and the way that they're marketing it that makes it an interesting dilemma, I think I would call it. It's not necessarily the biggest disruptive innovator, but it has some potential for product lines and getting into a bigger avenue of the business where you compare it to a Shopify. Shopify, I was just speaking last night with a store owner who had a Shopify on their iPad. And I said, I'm interested why you're using Shopify instead of Square. And they said, well, because Shopify does everything from soup to nuts. They help us build our website. We do our POS ordering right here off of our iPad. It takes the credit cards. It builds our entire business from the front to the back. One of the concerns was being Galaxy or Samsung-based versus you having to use an Apple product with it. And I'm not sure if it's just can't be used on Samsung's platform or if it was just a problem that they were having. But that's the big difference between Shopify and Square is Shopify does everything for the business owner as far as getting started, getting it up, doing the ordering, having the inventory, whereas Square is more of a way to process credit cards and take in revenue. Square has the ability to make substantial changes and to go into a couple different avenues, which could make it one of the leaders in that space where you're not talking about just Visa, MasterCard, Amex, and credit card companies. You're not talking Apple with like Apple Pay, but other product avenues within their sphere to the point where they're actually giving away the reader. If you needed something, if you're a small business owner, you need something to take credit cards, they'll just give you the swiper. Trying to build up the business, build up the clientele so that they can then leverage that into the next level of offerings that they're rumored to be coming out with. So that's something that we're watching closely to see what happens and when anything happens with it. Both stocks have been fantastic for investors. Square being $26 has it's easier for retail investors to get into. It's got great ADV. The upside there is pretty good. Shopify is $105. It's performed better in the marketplace. It does more, but it's kind of between the two, which one's going to win out in the long run. Right now, they're both winners as far as I'm concerned, but I think that very soon we'll be at the tipping point where one of these will make a clear leap above the other and become the industry leader.
So what kind of a breakdown do we see in the fund right now? And by that, I mean, it's a new tech and media ETF, but are most of the components in here more skewed towards the tech side, or is it more of a blend between the two?
It's more on the technology side. The media aspect is the social media. One of the other factors that we look at is when you talk about disruptive innovators and being FANG-like, is AI has to be one of the biggest things that investors consider or look at when you're thinking about what is current day FANG-like and what is future FANG. And that's really what we're looking for, too, is not just the FANG stocks, but what are the future FANGs that we can put into the ETF for investors so that they can get into a product that has them earlier rather than when they appreciate more. And AI is one of the big factors for that. So we had Twitter was in there because of some of the AI push that they were making. Snap was in there for a very short period of time based on some earnings valuations. Then we have like a Red Hat because of the chips that they've been making, being a competitor with Nvidia, making not the same chips, but competitive chips as far as the self-driving cars and some of the other AI components. AMD was in there for a period of time until we made the decision that Nvidia, definitely staying in there as the leader, and Red Hat being the closest competitor. Red Hat stays in basically on the strength of the chips and what they're used for, looking into the future of the AI chips and the higher technology and thinking machinations that other companies are going to use in the robotics aspect of it. That's why Nvidia has Red Hat and doesn't just sit in there by itself.
And I also see there are some technical analysis requirements for inclusion, such as simple moving averages and other items like that. Why do you think it was important to include this metric as well?
Well, the one thing that I've learned in my 25 years in this business is there are people that are good at picking stocks. There are people that are good at raising money. And the people that are good at picking stocks don't necessarily always have the right timing. There's literally thousands of cases of analysts and portfolio managers that were absolutely fantastic with the stocks that they picked to go into portfolios and mutual funds and ETFs, but they ended up being subpar because they didn't know when to buy or when to sell. And you don't want to be into a standpoint where you're trying to catch a falling knife. Say, oh, well, it dropped today, so I'm going to bottom fish. Well, what if it keeps dropping? Or somebody says, I really like this company, we should just buy it now. And then you lose 15, 18%, and all of a sudden your gains have gone, your clients are going. So we put the technical component on top of the fundamental analysis that we do as a buy and sell time frame. So we use some very basic technical analysis as far as, MACD, stochastics. If it's breaking down, we're breaking out from both a 50 and 150-day view, just to kind of give us some extra credence and flexibility as far as we know we want these stocks. But if the market's correcting like it was during part of August and the sector is selling off and tech's getting hit hard, do we want to go in and just buy it if it just broke through support? Because generally speaking, the stock's going to continue to fall until it bases. On the flip side, if we have something that we want to put into the ETF and it's making a basing pattern where generally from a technical standpoint, generally you're saying, okay, it's basing or it had the head and shoulders or an ascending triangle and now it's going to rip up. Those are the times that you want to start to put the money back into those stocks. So what we've done with free cash flows when investors come in and buy the ETF and we have cash to invest or we get creation units is we start putting it back in, not necessarily to the same percentages that are fixed in the portfolio right now, but we'll look at the names that are forming the strongest technical patterns and make sure that we put it into all of those names. And then there might be $1 million left over. And there's a couple names that are very weak technically, could go either way. Instead of just putting the money into those stocks, we might hold it off to the side or overweight some of the technically stronger looking symbols that are in the portfolio. Because at the end of the day, we want to have a FANG ETF, the characteristics of the modern day FANG, but we don't want to chase anything. We don't want to just buy something that is breaking down because it's currently a 3.2% weighting in the portfolio. And that way, if something goes wrong and we do sell it, the investor that bought the ETF isn't losing extra money on that one part of the ETF, the one underlying position, because the new funds went into one of these stronger stocks that were in there. And that's, I think, one of the reasons why, if you look over the last month, the ETF itself is down 1.8%, and the FANG names are down 3.4%. And if you take out Netflix, put in Nvidia for the FANG names, it's still down 2.3%. So the FNG ETF is outperforming the FANG names, whether at the end it's Netflix or the end it's Nvidia. And it's pretty much in line with the NDX and S&P for the last month. If we just put it straight across the board in the FANG, then we would probably be down an extra 1% or so.
Right. Okay, well, I think that's about all the time we have for right now. But Scott, it was great to have you on to discuss the new tech and media world. Thank you so much for joining us.
Thank you.
All right, everyone, that was Scott Fries, CIO at Sabretooth Advisors. You can learn more about their fund at advisorshares.com and by looking at the new tech and media ETF, ticker symbol FNG. Well, hope you enjoyed this edition of the Duchamp Report. Make sure to tune in for more interviews and discussions on the world of exchange-traded funds in the future. And for my thoughts on the ETF world, make sure to go on over to Zacks.com, check out the ETF Investor Service, which includes my top picks and commentary on the markets. And don't forget to find and review the Duchamp Report on iTunes. And if there are any topics you want us to discuss, feel free to reach out at podcast@Zacks.com, my Twitter page @EricDutrump, or leave us a comment on Facebook as well. But be on the lookout for a new edition of the Duchamp Report each and every Thursday. But until then, for Zacks.com, I'm Eric Dutrump.